Well, joining me now to finish the trading week is Michele Schneider, Chief Strategist at Marketgauge.com. Michele's first time on our show here at NYSE TV Live. Michele, such a pleasure to have you. Thank you for joining, and let's get right to it, of course, as we round out earnings from these big banks. Where do we stand?
Well, first of all, thank you for having me on. It's great to see you, Kristen. Well, the banks, obviously, let's even go beyond that, because it started out where the expectations for this earnings season was very low. And so already we're beating those expectations, and that's really good news. And also, we're on the third year now of the bull market, which means after 2 years of a bull market, some people think that we're going to sustainable market for a long time to come. And we're seeing very good reasons to be optimistic, the banks being one. But what the banks mean to me is now we have to really look beyond the big banks and into the regional banks. And the regional banks are important for many reasons. The top three would be A, we had that big crash in 2023. There are still stories out there that they're in trouble. They are tied to commercial real estate, which of course is part of the reason why they were in trouble. And now they look like they're starting to come back. And it's also tied to the small caps. And the small caps are so important at this juncture to really keep this rally going as we get through the rest of October and then into election season. So that's been all setting the stage for the soft landing. And now, of course, everything else has to behave, and that's always the rub, isn't it, Kristen?
What's been the turning point, Michele, for small caps? Has it simply been lower interest rates, the expectation of those, and sustained growth that I think has surprised many to the upside?
Well, definitely interest rates, because the small caps are very interest rate sensitive. And even though the yields have actually gone up since we had the Fed cut, I think the anticipation is that A, the Fed will continue to cut. It's just going to be maybe not quite as aggressive as it was out of the gate. And B, there is an anticipation here that we will reshore in the United States and domestic production will go up, even though the numbers we've seen recently have not necessarily supported that. The market tends to run 6 months ahead, looking ahead now who the next president might be. People are saying that this is an anticipation of a potential Trump victory. I don't know if I'd necessarily buy into that. All I know right now is that it does seem that we are looking to spend more money here to produce production and manufacturing here, which of course is where the small caps fit in.
Interesting. So Michele, of course, based on what we're seeing and where investments are going to be made, it does lead me to think about the election and, from your purview, how a Trump or a Harris administration might impact an investment thesis. Are you planning for different scenarios under different presidents?
Well, I actually would rather look at the commonality than the differences. And it's also really very difficult to know what somebody is saying in a campaign and what the reality would be once they're sitting in the chair. So in terms of the commonalities, I think there are a few that we can really count on. One, obviously, would be defense spending. I don't think either presidential candidate would cut spending in terms of that. I think that there's also, interestingly enough, a lot of buzz about cannabis and legalization. We'll see what happens there, but both candidates have sort of supported it. J.D. Vance more than Trump, but certainly Harris has just come out. Bitcoin and cryptocurrency is another one. But I think we also have to look at the more insidious aspect of both candidates, and that is neither one of them are dealing with the soaring debt or really talking much about saving money. In fact, if anything, spending money. They just like to spend it in different places, the Republicans versus the Democrats. So that's kind of where we have our eyes. So with all this roseate picture, we also have gold making new all-time highs, and people are wondering what cracks is gold actually reflecting. And so I think that's something to keep an eye on as well.
And Michele, I know over the years that we have spoken, certainly over the past few months, too, gold is something that's been on your radar, and pretty remarkable that it, as a defensive play, is right near a record at the same time that there is such momentum in stocks. And so, to your point there, what cracks might gold be insinuating?
Well, what we just mentioned, which is that a rising debt is unsustainable and it will affect the treasuries. And right now, of course, like I said, the yields have gone up, but today with housing starts, they're coming off a little bit. So that's something to watch, because if the yields come off too much to support the economy, then of course we have the idea of inflation, which of course everybody has dismissed, but I have not completely dismissed. Two would be, of course, the geopolitical situation. I mean, right now we still have a powder keg potential in the Middle East. And three would be the strain on raw materials that we're having with this incredible acceleration of mining centers, data and AI. They consume raw materials. Now, I know the conversation's turned to nuclear, and that's great, but it's not like tomorrow. So meanwhile, we still have copper to be looking at as something that is in rare supply. We have silver to be looking at, aluminum, tin, iron ore, all these raw materials right now are getting stretched. So anything could really basically upset the whole apple cart. And that's why I think you have to be nimble.
Okay, so to that end, Michele, being nimble, looking at what's happening in the gold market as stocks continue to climb, how would you suggest to investors, your clients that is, that they really round out their portfolio in this scenario heading into year end?
Well, let's step back and look at ETFs. So obviously, ETFs have been a tremendous trading vehicle and have really grown in popularity and liquidity. So I like to look at the ETFs that represent the sectors of the US economy. So the top three would be one we discussed, which is small caps, but the other would be transportation and retail. So if we just look at those ETFs and forget so much about stocks, because we could have a whole other conversation about that. If you look at XRT, which is the retail sector, and I like to present this one because it will spell opportunity. It has consumer discretionary and consumer staples. It's been, Kristen, amazingly, in a 10-month trading range of $10. If we put some numbers on it, between 70 and 80. And if it closes out October over 79, that would be the highest closing month in the retail sector. And let's face it, this all comes down to the consumer. Retail sales was strong. We need the consumer to stay confident. So if it gets out over that 80 level, 79, 80, as we get through this month and after the election, I think that tells you that there's a tremendous opportunity, especially in a lot of the areas of the retail stocks that have not performed so well, like in Ulta, for example. So that's something I'm looking at.
All
And the
right.
other thing I would Oh, I'm sorry. Go ahead.
Michele, we got to leave it there. We've got some other things to get to, but great to have you. And I look forward to you joining in person one day as well. Michele Schneider, she's the chief strategist of Marketgauge.com. Michele, thank you again.
Thank you. Have a great
All
week.
right.